In this video, you're going to learn everything you need to know about smart money concept, the secret behind the market movers, and how to profit efficiently with this knowledge. How the big banks, big investors profit and manipulate the market. Stick to the end. SMC. The smart money concept is literally a strategy and also a theory. This involves analyzing the market structure of a security and identifying potential entry points based on big institutional trading. Big institutions like the central banks, the commercial banks, big financial investors, and so on. It is well known that the market is being manipulated, but that is fallacy. It is not a food picture in another language, if you would. When it comes to currency trading, in particular, it is generally affected by the invisible forces of demand and supply. It is also known that no one person or group of persons control the market indefinitely. So what is the true picture? In most recent times, retail traders account for 10 to 20% of market volume, and the remaining 80 to 90% are traded by big institutions. So you see, when prices fluctuate within a price range, it is typically a tussle between the groups of buyers and sellers, typically the big institutions now. And another fallacy that has to be debunked is that if one big institution controls the market. Another fallacy also is that institutions group themselves against retail traders. One will say that some big institutions have to enter the market filling certain positions and waiting for the retail traders to fill it up while sweeping them out. That is not entirely true. One thing is fact. These big institutions are in for profit. Some will say they are greedy. In the market, there are two groups of people, the buyers and the sellers. So it's either you're a buyer or you're a seller. In that regard, certain institutions enter to sell an offer, hoping to push the price down to buy at a lower price, while another enters the market to buy at a certain price, hoping that this price will go up so that they can also sell off that which they've bought. This tug of war makes market to fluctuate and also causes break of structure. Some want the price to go up and others want the price to fall. So the group that prevails is the group with the higher number or liquidity, most times liquidity. So retail traders are caught up in this fight. How do you benefit from this? The only way to benefit from this is to align yourself with the institutions that are making the big moves in the market. As it is said, two elephants fight and the grasshoppers suffer. Assuming we got into this market at point A, all right, so this is the analysis we're making, and then you already know that now initially this is a bullish trend, all right, and then we now got to a supply zone that resisted this trend. Okay, so at point A there are sellers and these sellers are high, they are much, right? The few buyers begin to buy at a lower price. They go to the sellers that have the best price, all right, and because of that it begins to drop in price. So the market price begins to drop because sellers are not buying at point A. They believe that the price should go down, and because they are few, demand and supply, the law of demand and supply kicks in, okay, and it now reduced. So the because now this continued and then it got to this point B. All right, so at point B, remember this event caused more buyers to enter this market. So more buyers began to enter this market, and because as the price is low, definitely demand will be high. It's just about time. This thing actually changes with time. All right, so as the price goes low, demand will be high because the event will cause buyers to enter into this market. All right, they want to buy at a low price and sell at a high price. So now they begin to buy, and as it is, prices begin to go up because the sellers are few now. Sellers are few and demand is high, and these sellers now want to make more profit, so they begin to sell at a given price, All right. And remember that those that bought at some point begin to sell. All right. Those that bought at some point, within this range begin to sell. And also to mention, at the lower time frame, like the 1 minute time frame, the 5 minutes time frame, you'll be seeing, a bearish trend. But in this 15 minutes time frame, you are seeing a raging market. The order flow is sideways. All right. So now getting to this swing low B, you are seeing a resistance, retracing back on a pullback now, and then it moves the fluctuation here. So you see that the big banks, the big investors, these institutions right now, there's a tug of war between them, and as I said, that is grouped between buyers and sellers, buyers and sellers. All right, and then you will keep moving. No big institution or one institution holds the market indefinitely. All right, so at some point there will be people that will leave the market and some that will enter. So it's more like a randomized, action that are propelled primarily by this, the forces of demand and supply. All right. So if you are good with market structure, you will always be on the winning side. So all we want to do is to make sure that we are on the winning side. All right. So now this tug of war begins to happen. There's point C, you're going to see now a push in price. The price begin to go up. So we are seeing more demand. All right. And then at point D, there was a resistance right now. We are seeing a strong liquidity, a bearish liquidity right now, pushing it up. And then we see another movement then at point E. So point E is where we have to be cautious. All right. So all you have to do in your analysis is to draw this line to define the actual order flow of the market. All right. Define it here. All right, we are seeing that at this swing high, look at what it is, and at this, look at what it is. So now we are drawing it line as best fit here. All right, so this is where it's actually covered right here. Okay, so you're seeing A, B, C, D, E. So where our target is E, we want that sniper entry. We want that sniper entry. Well, remember, we are trying to also align ourselves with the current trend. The initial or previous trend is upward. All right. And if it's going to reverse, it's going to change a change character right now. It means that it should have broken at C. All right. It should have broken at B and it didn't break. All right. It didn't break structure. It could have broken at C. It didn't break. Then you see it repeating. So it's most likely that it will go up. So now this is where we take that sniper entry. So we go and give us, we're going to give, go for an aggressive move now. So before that, we are looking for a bullish liquidity sweep now. All right. So looking at this now, you are seeing a bearish liquidity sweep. So now, sorry, bullish rather. So there was a momentum, a strong momentum, or no, a bearish momentum, and then instantly you are seeing, a bullish, two bullish candles clearing it up. All right, already very strong ones, right? So now you are seeing that it is that is suspected now, and then you'll be waiting for a retracement because if you buy here, the stop loss may be hit, right? So you're looking for, that 8:1 strategy. So you just have to make sure that there's a retracement a little bit. So you'll be buying at this point, okay? Boom, you're buying at this point, okay? So when you get here, you are seeing that, you know, so you are seeing 10:1 now, right? You're seeing a powerful 10:1. All right. So these, the ratio is 10, okay. So that's it. You can imagine. And then comfortably, it made this profit. So if you are trading, your lot size is 0.01, you will be having $10, I believe. Then if it is, progressively, it could be 10, it could be 100, it could be 1,000, it could be 10,000, it could be 100,000. So depending on your risk management strategy and also the capital that you have. So this is it so it covers up for those that have big capital and for those that have a limited capital. So this is a strategy that is awesomely awesome. And you see, you can make your profit and actually leave the market. If you want to be over ambitious, you can even go higher, but right? But I would say that when you're trading this stuff, you just have to be cautious, right? You don't want to give yourself unrealistic expectation. And talking about unrealistic expectation right now, trading with market structure or trading in this market, it is very much important that um you understand how to calculate the average price range. The average price range, right? From A to B, C to D, and D to E. It's also going to make you make informed decisions. All right. Make informed decision in terms of your risk to reward ratio and also the best time frame to trade, right? This is really important and crucial. So if you want to learn this, all you have to do is to check the link below. I dropped this link on how to, market structure, study of market structure, and how to do this calculation. So make sure you learn it so that you can be very much effective in building what you want to build. All right. So if you learned anything in this video, if you learned anything in this video, please like and subscribe, share your comments, and let me know your opinion. All right. And that will be really, really helpful. In our next video, we're going to discuss on how to make sniper entries using trailing stops. We're going to talk about the time frame unity strategy, that when all time frames are in unity, all right, they are in sync. So we're going to talk about it and how to make much more informed decisions and profitable moves using this. So if you want to see this video, make sure you turn your notification button on so that you'll be the first person to see it. All right. Bye for now.